Hi, it's Dre Griggs with Obsidian Wisdom. Today I'll be creating a retirement plan and I'll walk you through the Wisdometric program that you can use to create your own retirement plan. It is such a simple way to be able to do it that you're going to love it. I'm going to go over some of the features and we'll show it. I'm actually studying for my CFP exam. I'm going to have that in maybe like 5 months. There are some case studies inside of the book that I'll create by hand, just using a financial calculator, and then we're supposed to be able to create all the information to be able to show the CFP that we have a certain set of skills that will be obviously beneficial to you. Now, like most things, if any of you went to college or you study different things, the steps that they have you do it is not how it's done in the real world, right? Like, we don't do most of our accounting with a spreadsheet with a T-chart, and we don't do most of our financial planning by hand or in an Excel. At least I don't. Now, I will go through this process and I'll show it to you. And so this one is actually, and I'll show you the book. It's cases in financial planning, analysis, and presentation, right? So this is the book that they give you. See, it's a decent sized book. It goes over a lot of the information. So this one is going to be case 2, and this is Alvin and Fran Jackson. So I will put the first name, I'll put Alvin, and then I'll put Jackson. And we won't worry about the email address right now. Normally, after I put the name and the email address, I would simply click invite client to input the information, right, if we just had a meeting, or if I'm having an on the phone and I'm going to fill it in while we're talking, then I'll put the information in now. So we're just going to put that as our choice. So I'll say, okay, I'm going to put the information in now, and then it opens. And so this is how it will look for you. You'll have 6 data points that you'll put in. You'll put the family information in, then you'll put your income in, any savings that you have, all the investment accounts. Will then calculate your net worth, add in your expenses, your overall goals. Poof, retirement plan is done. You can actually do this really as short as 15 minutes. So I'm going to look through here. Alvin Jackson is 43 years old. So I'm going to go here. So Alvin, if you are 43, I think that means that you were born in 1980. All right. So we'll say that. Perfect. Alvin, you are 43, born in 1980. And then your wife, her name is Fran. And Fran is 43 as well. I love it when it does that. It makes my life so much easier for me when they have the same age. All right, so Fran is the spouse, born here. I'm going to see if there's any children in this. It says, yes, they have 3 children, Curly, Larry, and Moe. So ironically, that is the 3 Stooges. So you'll just come here to add participant. You can add a child, a grandchild, or other, really anyone that you want to have considered inside of your retirement plan, your financial plan, your life plan, your family enterprise, however you think of it. So we're just going to add the 3 kids in. All right, so last name already comes. We have the first name. It just says child. So Curly is 12. So I'm going to say Curly. And then we'll go, and so if Curly is 12, I think that means Curly would have had to have been born in 2011. All right, so let's see if that turned out. Yep, perfect. So you're 12. There are 3 children, so we're going to add another one. All right, so the next child is Larry. And Larry, so I didn't bring everything over, so I'll do that again. All right, so then Larry is 8 years old. So then that would be 2015 for Larry, and you'll save that. Make sure, yep, 8, perfect. And then our last one is Moe, and Moe is 6. And so we will come to child, delete that, we'll say Moe. And then Moe is 6 years old, so that will make you 2017. And then we'll save that. We'll make sure, yep, 6 years old. All right, so that is the first set. So we've got that done. We have all the kids in there, and then you would just click either the next down here, or you can come to here and you can click it from up here. Either way, you are able to go through that. So we'll click it from up here to make life easier. I'll move myself kind of up here and out of the way. All right, good. All right, so now we need to put in our salaries and then any Social Security if you're already receiving it, and then you add any income that you have. If you have a business, we'll add the business. If you have a pension, an annuity, anything that you have income, could be child support, anything that you have income coming in, we'll add it here. All of your income goes on this one. All right, so I'll go back to the book to see. So it says Alvin Johnson, 43, works at Max Speed Company, a family-owned business that supplies the aerospace industry. Alvin has been with the company for 16 years. He plans to retire in 35 years at the age of 62. All right, so we got that information, but it doesn't tell us how much he's making. So I'll turn to the next page and see if I can figure out how much we are making. All right, so Alvin's salary is $75,000 a year. So we're going to come down here. Alvin's salary is $75,000 a year. It's already started. Normally your increase, most of the time it averages the 3% if you're keeping up with inflation. If you are uncomfortable with that, where you're like, you know what, Dre, I really don't get that raise very often. Okay, then we'll keep it at 0. But keep in mind that that is lowering your overall purchasing power each year, right? Like you're technically taking a 3% pay cut if inflation goes up by 3% each year. And so, all right, so income starts, already started. Income ends when you retire, right? This is my job, so when I retire, I expect that to be done. Now, if you want to have it done in a particular calendar year, you could say at the end of a plan, right, I'm going to work till I die. That's an option. Or the end of both plans, right? However you want to do it, right? You have that choice available. I clicked out of it, so I'm going to put that back in there, $75,000. That is Alvin, already started. Increase 8% says exclude from Social Security tax. No, that's being taxed. So Alvin expects that to be taxed. And then Fran's salary, it says Fran gets $50,000 a year. Let's flip back and see what Fran does. It says Fran grew up in Wisconsin and loves the outdoors. She moved to Seattle after high school to be close to the Pacific Ocean and milder weather. Fran learned to surf and spend a great deal of time in, on, or around the water, and she enjoys the water so much that she became interested in fluid dynamics and decided to attend college. College is where she met Alvin, who also enjoyed the natural beauty of the outdoors. We kind of keep going. And at some point, her love of the outdoors got Fran her job. It says she makes $50,000 a year. All right, so there you go. Fran, $50,000, same deal. When you retire, we don't expect to receive that salary anymore. So we have your income in there, and let's see if we get anything else. Okay, we don't get anything else. Now, as far as these Social Security icons, you'll see that they're already set where it says Alvin Social Security. The amount is estimated, already receiving if you're retired, and we're not. Your filing age, so full retirement, that would be 67 based on the year that we're born, and the month filing would just be the full retirement age. And so they said January because that was the birthday, right? We just left it as January 1st. So whatever your birthday would have been would have changed that number. And so then we have the estimated benefit amount. You have a couple choices here. You could use the simple estimate. You could say no Social Security based on the Social Security statement value, right? So if I had the Social Security statement, I had you go online and download it, I would just place that number in here. We're just going to estimate it based on the job and the income that you have, and assuming that you worked for another 35 years, then you should probably have a good estimate here. And we'll say based on historical covering earnings. So we're just going to leave that, just using a simple estimate. There's no reason to overthink it. And then as we get closer to retirement, we can add those amounts in there. Now, if you had any other income, you would add that. So when you go to other income, right, it could be like a bonus. If you get a bonus every year and you're like, hey, it's about $10,000 a year or something, well, that's worth mentioning. If you have a reverse mortgage, and then we'll put the amounts that you want to start in, and inheritance, whenever you get that. As things change, you can come in here and add the income, see how it would adjust your plans, and go from there. Now, granted, the difference between the income and then the savings or something like that is an income is something that's going to keep reoccurring. You wouldn't say my inheritance if you just received $100,000 once. That wouldn't be like an income. That would just be like a one-time thing, and we will put that in on the next tab, or at least the savings and investments tab. It would say, hey, we got $100,000 in a savings account, and then we'll figure out what to do, from there. And so in alimony, child support, royalties, that could be anything with your business, things like that, distribution, self-employment, and your salary. All right, so we don't have any of those for this case study, so we will go on to savings. All right, so for most people, the savings, they will normally already have it pre-set up for the 401k. We can adjust that in any way that works for you based on where your money's actually at. All right, so let's see what they have going on. And so inside the book, they give you the financial statements. So you're able to see their their balance sheet, you're able to see their income statements, and then you would be able to tell where their money's at from there. So from that, I can see that then inside of their investments, they have $200,000 in a stock portfolio, and it says that that one has a JT next to it, so that means it's joint tendencies, it means it's both of them. And then we have a 401k with Mach Speed. There's $250,000 in there. That is only the husband's. And then we have an IRA rollover account that has $28,000, and that belongs to just the wife. So those are the accounts that we have. So with that said, we'll go in here. Let's see if they have any sort of a match or anything. So economic conditions, general inflation expected at 3%. Okay, we got that. Education inflation 6%. It's because they have some wants for the kids. All right, so the plan, he has a safe harbor plan. So that means that the employer matches 1% for the first 3%, and then 0.5% for anything greater than that up to 5%. So the total possible employer match is 4%, and so that's where he's at. He's doing the 4%. Perfect. All right, so based on that, we'll come in here. Savings already started. He contributes 5% of his salary, so we got that. And then it says that the primary match, so see the primary match is 100% match up to 3%. The secondary match is that 0.5%, so 50%, and that matches only secondary matches to, and you'll see it applies to the amount of excess of it, so that's just 2%. So we're able to get a total of 4% is what we're able to have in here matched. All right, so we got that set up. He contributes 5%. It says 50% of the last 2%, which would equal the 4. So we're good with that. And so Fran's IRA, I know it still says 401k. You definitely come in here and just click traditional IRA. And then you click the owner. So it's Fran's. Saving already started. Puts in 3% of the salary. It's Fran. So when does it end? At Fran's retirement. And so we're done there. So that's the 3%. And so we're good with that. And then you could just get rid of this one. Yep, want to delete it. All right, so we have Alvin's 401k, contributes 5%, gets that 4% match. And then we have Alvin's taxable, which it's like saving the spot for later, so I'm not going to worry about that. And then we have a traditional IRA, and so that's Fran's traditional IRA. And then we contribute Fran annual increase. Oh, I was on the wrong spot. So that's not an annual increase of that. We want to have a target as a percentage of salary, and then we contribute 3%. And then we save that. Okay, now that, perfect. That makes more sense. So we're good on that one. And then we have a stock portfolio of $200,000. It looks like they contribute into that one. Their stocks about 5% of their combined salary. So again, it's not a set dollar amount. Actually, we'll change it to a percentage of salary. So they do 5% of the salary goes into just his, and we're going to go ahead and call it stock portfolio. And the owner is joint. This is a joint account. And so this one will end when both of them retire. They're sort of the same age. So we could just pick any of them, or we could pick the age. Everybody wants to retire at 62, it says. But we'll just say Alvin's retirement. Make it nice and easy for us. And then the savings already started. Percentage of salary. It's a joint account. Stock portfolio joint. We'll save that. All right, I'm looking. So I think we're good on that. That is all the money that we currently have going in. So we'll click next. Now you put in anything that makes the net worth. And so the net worth, you'll see that this is where you have all your money at. Now, when you're doing it, you actually could link the account if you want. And so any type of account link that you want to add, it will show you all of the accounts. Now, it doesn't have everything, but it has almost everything. So if you type in the name of a certain account, It'll give you the ability to pull it up. You'll put your login information, and then it will log into your account. And as a result, it will automatically refresh every time that you come in, so it keeps track of your debt, how much money's in your different accounts, and things like that. If that is too much for you, where you're like, I don't really like that, Dre, then you can just come in here and add it individually. So I'm going to move this over here to the side. There you go. Move it over here. So we'll say we'll add accounts, and then you can just add them manually in, and then you can update them on your own. So we're going to have a bank account. So how much money do we have in cash? Okay, so we have $22,000 in cash. So we can just simply say, we'll say checking account. Okay, and so we'll say included in the plan, yep, is in checking, or we could put it by the bank's name. So we'll just say, Bank of America. Make it easy for us. Checking, and then it has $22,000 in that account. This is a joint account, not trust. This is a joint account, and then we save that. And then you see it adds it here. Any credit cards that we have, so any debt that we have, you can put the account in by name, or you can just put the aggregate of them. I'm just going to put the aggregate of them. So we're going to just say credit cards. And so it says the balance is $8,825. And we'll say that is joint. Minimum payment, we'll say $100. And then you pay whatever you end up paying. You're like, but Dre, I pay $150 a month, whatever your interest rate is. So we'll say it's 20%. And then that's in there. So you see that one is done. We have, and then we can just kind of keep going. So we're going to go to investments. We know we have $200,000 in the stock portfolio. So we'll just say investments. This is a taxable account, which just means it's after tax. This is not like a 401k, 403b, or anything like that. And so our current balance is $200,000. And then you can choose the type of allocation that you have. You can create one that is custom. You could do it based on a model, and I do have some models already set in here for you. And so you can see that we have like preservation, you have conservative, you have balanced, and then it tells you what percentage you would allocate in each of those. So it's actually really nice for you. And then you have like a moderate. So we said that they had a moderate return, so we're going to just choose this one. It's a moderate return. So you have $200,000, a moderate return, and then the cost basis. Most people don't know what that is, so we'll just leave it at 0. And then you say yes, included in plan. This is a joint account. It's a taxable account. It's all the investments. This is the balance of it. Boom. That one is done. All right, and then you see it. Now it's over here on the side, and then we'll keep going. So we have our 401k. We're going to go ahead and add that in here. And so that would be like your stock plan, company, stock plan, current price, private stock is a symbol. Yeah. All right, you have that in there. And then we have our 401k, and that is just Alvin's. So we'll say Alvin's 401k. So this one, and we'll just come here, as you see, click on that bar, 401k, so it knows how it's structured. And then we're just going to enter the total balance. The total balance was $250,000. All right, and then the asset allocation, we're just going to assume basically the same deal. Let's just say he's consistent, so he has a moderate investment. And then this is just Alvin's. It's included in the plan, and then managed is just for me. Don't have to worry about that. But it basically means, do I manage it, or is it outside of what I'm managing? And so we'll listen to managing. So boom, that one is done. We have the IRA rollover account that belongs to the wife, so we're going to do that. And so in case you're wondering, investments is just like this. Hey, it's a lump sum of money. Stocks is just, hey, I own a couple individual stocks, and then we'll put the individual stocks in there. And so, but if you have a portfolio, then it would be easier for us to just choose investments. All right, so we'll do this one, and this is Fran's IRA rollover. And then you will find the rollover is a Roth rollover. There's a traditional IRA rollover IRA. So there we go. And then she has $28,000, right? So we're good there. And then this is actually Fran's. So this is just Fran's, managed by me. Adds that in there. And you can see over here on the side and the investment accounts, we have everything. Now we have the stock portfolio, we have the 401k, and then we have the IRA. So we're looking good on those investments. So then we'll keep going. All right, so any loans that we have, we'll add those in there, and we do, of course. So the property, you can have your investment property, a vacation home, anything that you want to add in there. Your insurance, you would choose those different accounts, add those in there as well. This one, we're just going to go to the loan. All right, so what kind of loan do we have? We have a mortgage. All right, so inside of the mortgage, they've actually almost paid off the mortgage. Good for them. All right, so we'll say the mortgage. It's a joint account. It's included in the plan, and then we'll say joint mortgage. You click here, say what kind of account it is. It is the mortgage account, so we're good on that one. The original amount, let's say it was $300,000. We'll say that's the original amount. And then the interest rate that they have is a 4%. So we'll say 4%. 30-year term. And then they look like they don't have a whole lot left on it, but we'll keep everything there. Then we'll say the monthly payments. Let's see what the monthly payment is on their mortgage. For that, I'll go to their income statement because it would show how much they're paying out. Okay, so they pay $24,000. So we're just gonna say they pay $2,000 a month. Let's ask us what the balance is. The current balance on their mortgages is $9,369. And then we have the no early payoff. Okay, so we're good on that. Everything's set on the mortgage. All right, so that's how much they have left. As you see, if it's a debt, it goes in negative. If it's an asset, it goes in positive. We're doing all this to create our net worth. All right, and then we will come back to add another one. They have an auto loan. So auto payment, and we'll just say auto loan. All right, and we'll say joint car payment. You'll click here, you adjust it to a car loan. The car loan looks like they have a 3%. The monthly payment, I'll go back to their monthly bills. It looks like they pay about $1,200 a month. The minimum payment is only like $400, but they're trying to get rid of it. All right, and so then you look at what they have left on it. They have about $13,000 left on it, right? So they're in the last year of that if they keep paying it off. All right, so the car is in there. Let's see what else we got. Okay, I think we're looking pretty good. We're looking pretty good. Okay, and then so for the property, we're gonna just click on the property. It has rented, so we're gonna click it to own. Primary residence already started. Current value, let's just say, is $300,000 to make it easy for us. How much do they pay in taxes? Now, you actually may or may not know, but you can go to the property appraiser website and you can look up any home's taxes, and then you can put that number in there. That's normally what I end up doing. I'll just look it up online. But they gave it to us for the case study, so that's good. The property taxes is $4,300 per year. And then their insurance I'm just looking. All right, so the insurance on the home is about $3,600 per year. Annual maintenance, so we'll say maintenance is like $1,000 a year. And then the appreciation, the increase, you purchased it for $300,000. It's currently worth $300,000, right? So you're good on that. You got everything in there. Okay, so you got that saved in there. And then you'll see it over here. So you have your primary home, $300,000. So then we'll just keep moving. You got your insurance. All right, and then we'll click over and we'll see. So for life insurance, they have a couple policies, and then you'll come down here to insurance. They have a couple term policies. So this is already there, so that's going to be Alvin's. His premium is $1,200, pays about $100 a month. His death benefit is $150,000. And then we'll say his policy ends, and we'll just say calendar year. It looks like he has a 15 years. So we'll say it ends in 2038. 100% beneficiary. Yeah. So the owner is Alvin. The insured is Alvin, and then the wife is the beneficiary. So Alvin is done. And then we'll have Fran's in there. So Fran is insured. Included in plan. Yep. So Fran will the same deal, about $2,700, 2038, and the death benefit is about $150,000, right? So Fran is good too. So we have that for the insurance. So that's in there. So everybody's good. And then do we have any others? And we probably, for the sake of time, we'll probably just kind of keep moving. But I will show you what the others looks like. It's just one of those weird things where if it doesn't fit anywhere, then you can add it in there. It really is. It could be right a lifestyle, note receivable, business, and then it has the different type of business incomes because they get taxed differently. And so you get to place those in there if they just don't fit right anywhere. And then you're good on that. So, all right, so we got all that done. It shows us having then, based off the house being paid off, it shows us having a net worth about $770,000. That's our investments, is this, and then our properties, and then you subtract the other debts, and that's what we have. If we went and changed our mortgage, right? So if we said, instead of us only having a balance of $9,000, if we said we had a balance of $275,000, right, you'll see it updates that, and then naturally updates the net worth. So now the net worth is only $500,000 because we have this mortgage still out. All right, so then you come to your expenses. Now, for the most time, we'll just put in a specific amount. So you have the pre-retirement living expenses. What is your monthly expenses? I'll give you like a little calculator for you to be able to put it together. You have the ability to do a detailed worksheet, which I probably wouldn't. But if you're not sure, then it'd be a great way to do it. You'll say, okay, how much do I spend on these different things? If you have an idea, you're like, hey, we spend pretty much what we make. Like it's really close to that. Or we spend $3,000 on the mortgage, and you just kind of go through it. So we could do anything. So you can say, I spend about $7,500 a month in monthly expenses. Right, so we could do that as the simple approach. The taxes, we just put in your status, and then it kind of calculates the rest of it for us. So we're married filing jointly or married filing separately. We already said you're married, so you can't kind of do that one. And then you'll do the local taxes. You click on that. It says enter the percentage of the AGI to be assessed as the city. And so we'll say that 0% of that. The average AUM fees, and that is to all non-annuity invested assets, reducing the annual returns, which is a very fancy way of saying what are you paying the advisor. Now mine are going to be flat fees, so you don't have to put anything in there. But if you just want to see what it looked like, you could put in 1%, and that's done. Any expenses that you want to add outside of that, could be medical, alimony, any extra debt, anything like that you're like, hey, I do want to cover this. Tell me that when you were divorced, when does this expense end, and when does this expense start? and we can go through anything and cover that for you, any of those extra expenses. So some people, they'll be like, oh, Dre, I'm gonna spend some money in the future and I have kind of a set. I would say save that for goals. So once you're done with that, you go on to goals. And so the goals is the retirement age. We want to retire at 62. That's what we told them. So that's what we want to do. Retire at 62 years. So bam, both of them are set for there. Your retirement expenses, I forget what we put in there. So we said $7,500. For most people, you would say, I'm going to pay off certain things. Based off of that, I'm going to adjust my retirement expenses. But if you say, I'm going to have everything the exact way it is now, then we'll just keep it that way. And then the spending strategy would be inflation adjusted. Very fancy way of saying, I'm going to maintain my lifestyle. So even though inflation will go up by 3% each year, that means my spending is technically going to go up by 3% each year. And then we do have in here is automatically added where you have your annual retirement health cost. So roughly estimating the ages, 65% of people, no, I think it's like 70% of people who are 65 and older are going to have a long-term care episode. And so we have that covered in here. So that's your annual health cost, long-term care cost. As you'll see, this is based on the last 2 years of the plan for each of them, and then the type. So we're going to have an in-home care, and then we use the national average, both of them. If you know exactly where you're going, or if you're going to be in home, assisted living, or a nursing home, then they'll place the national average in there for you. They say normally if you estimate it to be about 3 years of your retirement, then you're pretty good. We also automatically add in the 3 kids. So we have Curly, Larry, and Mo. So it just basically takes their age. It says college starts when they're 18. Use the national average expense. And then we can add any scholarships that are in there that you believe are set. Look, Dre, I got a juggernaut. This kid's going to have a 5.0, going to have a perfect SAT score. They're going to have colleges knocking on the door. That's fine. Then we can put that in there. You can say, hey, I expect all of my money to be covered, and we could put that in there if you want, or if you're going to play sports or anything like that. So that's the annual amount that you would expect. And this is saying, everybody, when you start at 18, we're going to take the national average, and then we just place that amount in there. Oh, I actually don't want to delete that. If you don't want to pay for anyone's college, you could just remove it and you'd be good to go. If there's any other goals, we can add them in here, where you say, hey, Dre, we want to take a vacation. Okay, well, that's cool. So we'll say family vacation. Okay, and you want that to be, let's say it's $2,000. And you say, well, I know it's not going to happen right now, so I want to start in next year. So we'll say 2024. And then what's the frequency? Do you want to do this one time? You want to do it every year? You'll say, Dre, you want to do this every 3 years. Okay, cool. And then when do you want this goal to end? You'll say, hey, we want this goal to end never. So you'll just say at the end of both of your retirements. We will always take a vacation every 3 years, Dre. It'll be about $2,000, and then we keep up with inflation because we want to still have the same party. And then we'll add, it says, like if you want to get a new home, you're like, hey, we're going to add a new vacation home. I'm like, okay, that's cool. Let's do that. So you'll say, let's add new vacation home. And you're going to sell the one that you have, so you're going to move. Primary residence relocation. How much is that new home going to cost? We'll say it's going to cost $350,000. Okay. And it says you want to buy a new home. What state? Pick it. We'll say Florida. That's where I'm at. It's a beautiful place. You should come. Absolutely gorgeous. When? You'll say, okay, well, we want to do that after, like right before we retire. So we'll say 2038, like right when you retire. So the annual appreciation, so that way we can start putting the money away for it. The property tax, we'll just say it's about $4,000. We'll leave it about the same. We'll leave everything roughly about the same as you have on your current home. You can get a 30-year on that one. We're going to say you have a 20% down payment, 5% interest rate. They're a little bit higher. And then the current home, you're going to either sell it, convert it to a vacation home, or convert it to a rental home. Those are all the choices that you have. All right, so then we'll save that one there. Is there anything else that you would like to do? So you want to gift it? Do you want to give it to charity, personal, any legacy plan? You want to put that in there? If not, write your kid's wedding, or you're paying for anyone's wedding, all that fun stuff. New home, place it all in there, give it a date. It's a beautiful thing. And then that is it. So then you complete the plan. And once you complete the plan, you can click over here on Blueprint, and it will show you everything that you place in there, right? So we have the 3 kids, Larry, Curly, and Mo. It has Alvin and Fran, your net worth. We already talked about messing with the numbers on that. And then your accounts that are joint. So these are the ones that we have assets. These are the ones that are liabilities. So that's listed here in the middle. Fran has her own rollover and her own insurance. And then Alvin has his own investment account. And then we put the primary residence in his name, and we can go back and actually change that. So if you click on it, and then we'll say it is joint. Right, so we'll update that to joint, and then it's automatically updated. So now the primary residence is here with both of you. And then we have his lifestyle asset, and then the stock plan. Those are just things that we're clicking on to show you. So if we wanted to get rid of those, we come over here, delete. Right, he doesn't have any stock plans, so we're just going to delete that. And he doesn't have a lifestyle asset, so we're going to delete that. And then so now we have the auto and everything is good to go. So this is that. Click on your goals. This is what we're talking about in our goals. We said, hey, we want to be able to have this lifestyle vacation, and we want to be able to do it every 3 years. So it shows you every 3 years. Curly starts college here. You'll see our age. We're 50 years old. That's 2029. And we still have our vacation. So are we still going to take our vacation that year? I don't know. But right now it's in the plan, and we'll be able to budget for it. Curly is still in college. So now we're 51 years old. Curly's still doing college. Curly's still doing college. Now we're 53. Now our next vacation. And then Curly's done. Curly graduated. Yay, Curly. And then Larry starts college. So we're 54. Larry, Mo starts college. So you can see 2035 when we're 56 is a pretty expensive year. Yeah, we have Larry's college, Mo's college, and we have our vacation. Do we want to adjust something? I don't know. But then we have 2 years where we have 2 of our kids in college. And then after that, we'll see that Larry has graduated, and then just Mo is in college. And then 2038, we move. We still have our vacation that year. I don't know. Mo's also in college that year. Keep that in mind. Do we want to adjust that? I don't know. And then you see that we have another vacation when we're 62. And then we have both of our retirements at the 63. And then we have some of our healthcare costs that go in there. And then our overall retirement monthly expenses. You see everything goes into the plan. You can see exactly how old we are and when it's going to happen. It helps you to be able to see it. And then once we're retired, all the kids are done with college. All we have left to do is to have some fun. So you see the rest of your plan is just the vacations. The long-term care cost, we said at 89, that popped in the last couple of years. That's completely your choice, whether you want it to happen or not. You can say, Dre, we are phenomenal on health. I'm not worried at all. And that's fine. You don't have to worry about that at all. And then your last lifestyle vacation, and then that would be it. You click here on the income, the savings and expenses. It has everything. So it has all of our income. It has the savings, the percentage that we save, and it has the overall expenses. So you can see that pretty nice and straightforward. Now you will be able to click on any of these. So the estate, if you have any of these documents done, we could check them off, or I can work on it for you. As far as the taxes is concerned, it's a very nice system as far as what it puts together. You have your education expenses for each of your kids, and then it says that we don't have any money really set aside right now, so that means we're $161,000 short of what we expected to be able to pay for 4 years of Curly. The same in 196, right? We added the inflation, so that's why it's higher, and then it's the highest for Mo because the years that we are going to be doing this. You can come in here and you can add that information. You can say, all right, we're going to have this amount of scholarships. You're going to have this amount in the 529 plan and different things. You can update it, and then that money will be updated as you go. The insurance that you put in there, we said we have $150,000 for each of you, and then the protection needed is actually $800,000 based on your income. And so you would say, okay, I'm short. I'm missing some insurance, and so you would add that. So we would propose adding the life insurance to cover it, and you may say we're going to be okay, I'm not worried about it. That is your choice. Then when you click on the retirement planning tab, the beauty of this one is it gives you the probability. It says if you do nothing more than what you've already done, and they'll say, hey, you got a 0% probability of success. You're going to have to make some changes to your overall retirement plan. We're going to need to increase some of the assets. We're going to need to add some different funds, and then that's where the beauty of creating the plan comes into place for you. And then you're able to do what's called like a confidence interval. It's like, hey, you're going to run out of money at this point in time, and then you'll be like, all right, what do I need to do to be able to fix that? And so it's saying, hey, look, with your annual expenses, your saving rate is 6%. This is the total income that you have. And so you'll just come in here and you'll make the adjustments, and then it gives you the overall retirement details and just says, hey, you're going to actually need about $8 million to maintain that lifestyle that you're talking about, and that you have a 27.5% of the income is stable, and then you're kind of running low on it. And then if you click on the Social Security, it shows what you would get. The optimal is normally just saying, I'm going to wait till I get full retirement. If you want to retire as early as possible, it shows what you would get, right? So that'd be about $630 less than that, and then you can adjust this. So right now they're set. Now, of course, that's my dog. He's gonna start barking when I'm recording. I'm not gonna worry about him. Stress testing, just as it says, you don't have to really worry about all this, but it is in here if you like to geek out on numbers. The stress testing is just your ability to say, if some things happen, what will happen to my thing? So if equity market drops immediately by 20%, and you can adjust this and say, okay, if it drops by 50%, what's going to happen? If it drops by the 20%, what's going to happen? You can adjust any and all of these. You and your spouse will live 5 years longer than we expected. Your healthcare costs go up a certain amount. You change it. So we have that, and then you refresh it, and then it updates the numbers to let you know the possibility of it being successful. And so you can play around with those numbers like that. Also has your cash flows, which is just a very fancy way of saying, like, all right, this is the money that I have, my salaries, these are my outflows, right? I spend that much money, and then I have living expenses of $90,000, the house, the debt. It gives everything really nicely, the amount that goes to taxes, and then it lets you know, hey, what do you have? Well, you have a net cash flow of negative $42,000, right? You're spending that much more than you take in, which is why this retirement plan doesn't work, and then we would obviously adjust it from there. Your investments, we have all of them. So you have all of your investments. We're looking at like a moderate allocation. That's roughly what we have. And then you can adjust the numbers. It tells you where people would invest for a moderate allocation, gives you the allocation by sectors, all that stuff. And then when you first log in, you'll see what's called the dashboard. It's like a one-page retirement plan. So you can see your net worth. You can see your effective tax rate. You can see the probability of success. Gives you a balance sheet of where all your money is located at, where all your money is going. It shows you your asset simulation results of the proposed plan, which, right, we haven't finished that yet, so everything goes off a cliff. Then your current allocations, your tax allocations based off of what you have. You have tax deferred, that's what's inside of our 401ks and IRAs, and then you have your taxable assets, that's inside your brokerage account. Then you're able to make any changes to that. You're able to add really anything that you want in here. You can add your savings rate, withdrawal rate, your total effective tax rate. You can add any of those in here. You can add the stress test, the income sources, the education, the kids funding analysis. Anything that you want can be added to this front page. It does get a little, it gets full, so you don't want to add everything in there. But you can see everything. So that's a snapshot. You can see your balance sheet. So these are assets, liabilities, your net worth. We have our liquidity, just how much money we have. Our target liquidity is $35,000. We have $34,000. And then it lets you know you have a surplus or deficit. So you're about at even. Your overall budget. And that's only if you link the accounts. So we won't be able to do that. You can look at your debt. And so basically the debt that you have, you would be able to get rid of your debt by 2038. And then you have the student loans. We didn't put any student loans in there. If this is something that is of interest to you, then you can go to Obsidian Wisdom. You can gain access and try this out for free for 14 days. If you found value in this video, I simply ask you to like and subscribe. We always spend our time showing you how to unlock generational wealth through strategic retirement planning.